What if I told you that the biggest financial crash in human history is coming? And there's a specific window when it will likely hit. Not a guess, not fear-mongering, but a pattern so reliable, so precise, that it's predicted two of the worst economic disasters in modern history. And right now, every single warning sign that appeared before those crashes is flashing red again. Stay with me, because what I'm about to reveal could save your financial future, or at least help you understand what's really happening while everyone else is caught off guard. If you're new here, this is Monetary Archaeologist, where we dig deep into financial history to uncover patterns that repeat themselves. If you find this valuable, hit that subscribe button and the notification bell so you don't miss what comes next. Now, let me show you something disturbing. Picture this. It's 1928. The stock market is booming. Everyone from factory workers to doctors is buying stocks. Newspapers are filled with stories of ordinary people becoming rich overnight. Experts are saying we've entered a new era where crashes simply can't happen anymore. One famous economist even used the phrase permanently high plateau to describe where the market had arrived. Then October 1929 came. And in 3 brutal years, the market lost 89% of its value. Families who felt wealthy one day were standing in bread lines the next. Fast forward to 2006. Housing prices are exploding. Banks are handing out mortgages like candy. Everyone believes that home prices never fall on a national level. It's different this time, they said. Real estate is the safest investment. Then 2008 arrived. The housing market collapsed. Banks failed. The stock market dropped 57%. Millions lost their homes, their jobs, their life savings. Here's what's terrifying. The same exact conditions that existed before both of those crashes exist right now in 2025. Not similar conditions, identical conditions. Let me break this down so you can see it clearly. Right now, we're living in what many economists quietly call the everything bubble. And I mean everything. Stocks? The market has been climbing for over 15 years. Valuations are stretched beyond anything we've seen historically. Real estate? The median home in America costs $420,000. The median household income is $75,000. That's a ratio of 5.6 to 1. Historically, a sustainable ratio is 3 to 1. That means housing is roughly 87% overvalued compared to what regular people actually earn. Want to know something scary? Before the 2008 housing crash, that ratio peaked at 5 to 1. We're higher now. But it gets worse. Corporate debt in America has hit $13.5 trillion. That's 72% of the entire economy. Before the 2008 crisis, it was only 43%. Government debt, $36 trillion. That's 120% of GDP. Interest payments alone are approaching $1 trillion every single year. Consumer debt, from credit cards, car loans, and student loans, over $17 trillion. Add it all up, and total debt in the American economy exceeds $90 trillion. That's over 320% of our entire economic output. Every sector is leveraged beyond historical norms at the same time. Stocks, real estate, corporations, consumers, government. Everything is expensive, everyone is in debt, and almost everyone believes prices will keep climbing forever. Why do people believe this? Because for 15 years, the Federal Reserve has trained them to believe it. Since 2009, every time markets started falling, the Fed stepped in. They cut interest rates. They printed money. Quantitative easing, 1, 2, 3. COVID stimulus. The Fed pumped over $8 trillion into the system between 2008 and 2022. Where did all that money go? Into assets, stocks, real estate, bonds. Prices went up and up and up. Investors learned a simple rule. Buy the dip. The Fed will rescue you. This created something dangerous called moral hazard. Nobody fears risk anymore because risk has been eliminated by central bank magic. But here's the problem nobody wants to talk about. The Fed has already used its ammunition. Interest rates sat at 0 for over a decade. They can't go much lower. The Fed's balance sheet ballooned from $800 billion in 2008 to $9 trillion in 2022. There's limited room to expand further without sparking another inflation crisis. And remember what happened in 2021 and 2022? Inflation exploded. The Fed was forced to raise rates from 0 to 5.5% in just 18 months. That was the fastest rate increase in 40 years. They killed inflation, but they created new monsters. Higher rates make all that existing debt more expensive. A company that borrowed at 3% now has to refinance at 7%. Mortgages that were 3% are now 7%. The debt burden is crushing. And the Fed can't lower rates significantly without bringing inflation roaring back. They're trapped. Rates too low means inflation returns. Rates too high means the debt becomes impossible to pay. There's no good option left. This is the setup. Maximum valuations, maximum leverage, a Federal Reserve that has already fired all its bullets and has nothing left for the next crisis. Now, let me show you what could trigger the avalanche. There are 3 likely candidates. Any one of them could start the chain reaction. The first trigger is already happening right now. Commercial real estate is collapsing in slow motion. Office buildings across America are sitting 40 to 50% empty. Remote work changed everything. Companies that used to lease 5 floors now lease 2. This isn't temporary. This is permanent. These buildings were financed with mortgages at 3% interest. Those mortgages are coming due right now. They have to be refinanced at 7 or 8%. Do the math. A building that barely generated enough rent to cover its debt payments at 3% is completely bankrupt at 7%. The numbers simply don't work. Building owners are walking away. Even huge players like Brookfield, one of the largest real estate companies in the world, stopped paying on 2 major Los Angeles office towers in 2023. They handed the buildings to the bank. Why? Because those buildings are worth less than what's owed on them. Over $2 trillion in commercial mortgages come due between 2025 and 2027. If just 30% default, that's $600 billion in losses. Who's holding these toxic mortgages? Regional banks. Community banks and regional lenders have massive exposure to commercial real estate. Some hold 20 to 40% of their entire loan portfolios in commercial property. When those loans default, banks must recognize the losses. Those losses eat through their capital. When capital falls below legal minimums, regulators close the bank. We've already seen the first cracks. Silicon Valley Bank collapsed in March 2023. Signature Bank failed the same week. First Republic went down in May 2023. If commercial real estate defaults cascade through 2025 and 2026, we could see 50 to 100 regional bank failures. And bank failures create panic. The second potential trigger is a major corporate bankruptcy or sovereign debt default. Hundreds of corporations borrowed money at super low interest rates during 2020 and 2021. That debt is maturing now. They have to refinance at rates that are double or triple what they paid before. Some companies cannot afford it. If a major corporation, a Fortune 500 company, defaults on its bonds, it triggers contagion. Bond investors panic. They sell other corporate bonds. Interest rates spike. Borrowing becomes impossible for everyone. More defaults follow. This is exactly how 2008 spread. Lehman Brothers failed. Everyone assumed other banks would fail too. Credit markets froze solid. The dominoes fell. The same thing could happen with corporate debt. Sovereign debt defaults work similarly, but at a larger scale. If a major emerging market like Turkey, Argentina, or Pakistan defaults on dollar-denominated debt, investors start questioning other countries. Capital flees. Currencies collapse. More defaults follow. This creates a global credit crisis that spreads from emerging markets to developed markets. One default triggers the cascade. The third potential trigger is a geopolitical shock. War, pandemic, terrorist attack. A contested election with violence. Any event that spikes uncertainty and forces investors to sell assets to raise cash. The COVID crash in March 2020 was this type of trigger. The pandemic wasn't an economic problem initially, it was a health crisis. But the uncertainty forced liquidation.
When you don't know what's coming, you sell everything and go to cash. If another shock of similar magnitude occurs, maybe a war with China over Taiwan, conflict in the Middle East disrupting oil supplies, or a violently contested American election, any of these could trigger the same flight to safety. Any of these three triggers could start the cascade. But here's the thing. The underlying cause is the same in every scenario: excessive valuations and leverage. The specific trigger almost doesn't matter. Once liquidation starts, the mechanics take over. And those mechanics are brutal, predictable, and devastating. Let me walk you through exactly what happens once a crash begins. This is based on what happened in 1929 and 2008. The sequence is always the same. First comes the initial shock. The trigger event happens. Markets fall 10 to 15% in just days. Investors are surprised but not panicked. Most see it as a buying opportunity. Buy the dip. The Fed will step in.
Stocks are on sale. Media outlets interview experts who say fundamentals are strong. This is just temporary volatility. In 1929, the initial shock was October 24th, Black Thursday. The market fell 11% in one day. Bankers met and pledged to support the market. Stocks recovered slightly. Everyone believed the worst was over. In 2008, the initial shock was March, when Bear Stearns collapsed. The market fell 15%. The Fed arranged a bailout. J.P. Morgan bought Bear Stearns. Crisis averted. Or so everyone thought. Next comes the false recovery. This is the most dangerous phase because it convinces people the crisis is over. After the initial shock, markets stabilize or even rise. This lasts weeks or months. In 1929, after Black Thursday, the market recovered for about a week. By early November, stocks were nearly back to pre-crash levels. Investors who sold felt foolish. Those who bought the dip felt like geniuses. Then November 11th arrived. The market fell 13% in a single day. The real crash had begun. In 2008, after Bear Stearns collapsed in March, markets actually stabilized through spring and summer. By July, the market was only down 10% from its peak. Many analysts called the bottom. The financial crisis is contained, they said. Then September arrived. Lehman Brothers failed. The market fell 40% in 6 weeks. Then comes the cascade. This is when the real crash happens. Forced selling, margin calls, pure panic. In 1929, the cascade lasted from November 1929 to July 1932. The market fell 89% over 3 years. In 2008, the cascade was faster. September 2008 to March 2009. A 57% drop in 6 months. Here's how the cascade works mechanically. First, leveraged investors get margin calls. People who borrowed money to buy stocks are forced to sell when prices drop. The broker demands more collateral. If you can't provide it, they sell your positions automatically. These forced sales push prices lower. Then institutional investors face redemptions. When funds fall, investors want their money back. Mutual funds, hedge funds, and pension funds must sell stocks to raise cash. More selling pressure builds. Then algorithmic trading amplifies everything. Computer trading systems see prices falling and automatically accelerate the selling. Stop-loss orders trigger. Circuit breakers halt trading, which creates even more panic when markets reopen. Then liquidity disappears entirely. When everyone is selling and nobody is buying, there are no bids. Stocks don't just decline, they collapse. They gap down 10, 20, 30% because there's literally no buyer at any price. Then credit markets freeze. Banks stop lending. Why lend money when borrowers might go bankrupt tomorrow? Credit freezes. Companies that need to refinance debt can't. They default. Banks that lent to those companies take losses. The cycle accelerates. Eventually comes maximum panic. This is the bottom. Fear becomes so extreme that people sell everything regardless of price. In 1929, the panic bottom came in July 1932. The Dow was at 41, down 89%. Unemployment hit 25%. Banks were failing by the hundreds.
In 2008, the panic bottom came in March 2009. Unemployment reached 10%. Major banks were insolvent and only survived because of government bailouts. This moment of maximum fear is also the moment of maximum opportunity. Finally comes the slow recovery. This begins when the government intervenes massively. In 1933, Roosevelt launched the New Deal, created jobs, reformed banking, restored confidence slowly. But here's something most people don't realize. The market didn't return to 1929 levels until 1954. That's 25 years. In 2008, the recovery was faster. The government bailed out banks. The Fed printed $3 trillion. Stocks reached new highs by 2013, about 4 years later. After the coming crash, the government will intervene again. The Fed will cut rates to zero. Congress will pass multi-trillion-dollar stimulus. Banks will be bailed out. But the recovery could be slower than 2008 because debt levels are so much higher now. Adding trillions in stimulus when government debt is already at 120% of GDP pushes it toward 150 or even 180%. At those levels, paying interest on the debt consumes tax revenue. The government faces impossible choices: raise taxes dramatically, cut spending savagely, or inflate away the debt. The recovery could take 5 to 10 years. Stocks might not reach 2025 levels again until 2032 or later. Now here's the part nobody talks about. Every crash creates a massive wealth transfer. Money moves from those who don't see it coming to those who do. Who gets destroyed? Middle-class families holding stocks and homes. In 1929, middle-class families who invested in stocks lost everything. People who felt wealthy in 1928 were destitute by 1933. In 2008,
Homeowners who bought at the peak lost 40 to 50% of their home value. Many owed more on their mortgages than their homes were worth. In the coming crash, the same pattern will repeat. Retirement accounts could fall 50 to 70%. A $500,000 401k becomes $200,000. Decades of savings vanish. Homeowners who bought recently at peak prices could see values drop 30 to 50%. Small business owners go bankrupt when customers stop spending. Over 170,000 small businesses closed during 2008. The next crash could be worse. Anyone who borrowed to invest gets wiped out completely. Margin calls force liquidation at the worst possible prices. They don't just lose their investment, they end up in debt. But crashes also make people extremely wealthy. In 1929, Joseph Kennedy made $50 million by betting against the market. That's equivalent to several hundred million today. Others held cash and gold, waited for depression prices, and emerged richer than before. In 2008, John Paulson made $20 billion betting against subprime mortgages. Michael Burry made $700 million. Warren Buffett made billions buying Goldman Sachs and Bank of America at crisis prices. The same playbook will create the next generation of billionaires. Who profits? Cash holders. Investors who sold before the crash and held cash or treasury bills. When stocks fall 60%, cash